On the podcast this week, if you go down to the woods tonight, maybe you'll find those hidden taxes lurking in your group structure. Welcome to the Profit Cash Growth Podcast. This is the podcast for 6 and 7 figure business owners who are looking to grow a financially successful business. My co-host, Claire Hancott, is a finance director, chartered accountant and entrepreneur. And every week, I'll be exploring guidance and frameworks designed to help you increase your profits, improve your cash flow and grow your business. This week, we here have been to Preston.
We have, haven't we? We had very nice tapas in Preston.
Yeah. Now, I didn't want to prejudge it because we probably have people that live in Preston, but I wasn't expecting a lot, and I was delighted by the tapas place we found. We can't even give them a shout out, can we? I can't remember the name.
I think it was El Fino.
El Fino, yeah. Absolutely sensational tapas place. I mean, the view from the restaurant of the high street wasn't great. Granted, but the good news is since we went to Preston, it's really put it on the map for me, because I heard somebody talking about this week about it's one of the towns, I think it's a town, not a city, that has quite a huge investment budget allocated to it, apparently.
Well, I mean, it's quite close to some major hubs, isn't it? And it's got a university there, and actually, it felt like it was undergoing a lot of regeneration down there, which was quite interesting. I found it really interesting when we were sitting in the restaurant. It was like a second floor above a bar, and we were overlooking a bookshop, weren't we? And it had a sign in the window and it said, been making books for over a century or something like that, wasn't it? And it was like you could basically go in and request any book and they would print it on demand, was kind of what the signs implied. But I thought it was interesting. We were trying to guess how old it is, but we guessed that those signs had been there since the 60s, hadn't we? So it's probably coming up to 150, 160-year-old business. It was interesting.
Or set in its ways, other words might be. Is the North keeping up with the South when you describe things like that? That's the feeling it gives you, isn't it? It's like, definitely. Come on. One thing I
always comment on when we go, because obviously you're from Leicester, so we go to Leicester quite a lot, but whenever we go north, like Leicester or above in the UK, I always notice that there is a significant difference in the number of independent businesses that are in town centres and high streets and things like that. It seems much easier to run an independent business up north than it does down south, for sure. And obviously that's going to have a lot to do with the cost of being on the high street and business rates and things like that.
And that segues us nicely to my favourite business of our Preston trip, and talk about doing what it says on the tin. And actually, just to test you on this, so we drove past this shop and I was just like, it was amazing. It was called Puff Tan Bang. Puff Tan Bang. So,
sorry, just for our southern audience, it's Puff Tan Bang.
Puff Tan Bang. I just thought it got my attention immediately. What amazing marketing. But it's the weirdest selection of things under one roof ever, wasn't it? Because it was vapes, suntan, and fireworks. All in one shop.
Yeah, it wasn't even that big a shop, was it? It was just like a little high street shop on the side of like a busy road.
Get your vapes. So you can go in there, you can get your vape, you can sit on your sunbed, and you can buy some fireworks.
All at the same time.
How did those three things? Do you know what I think that probably is? In a really smart business way, it's probably three of the most high margin things out there that don't really work together and really don't work seasonally at all. But someone's just gone, well, these make really good money, so let's stick them all together.
It was on a busy road, wasn't it? So it had eyeballs on it. So I'm sure that's why it worked.
If you're in Preston anytime soon, go and visit our friends at Puff Tan Bang. Right, let's find out what's this week's news story of the week. So this week, Claire, ministers to decide which car makers will be taxed at 10% in the US. I picked this out because I just thought, poor old car manufacturers.
Yeah,
I mean, can you imagine the fate of your business profitability being in the hands of our government? So basically,
Donald Trump, to be fair, it is in Donald Trump's hands, which makes it a little bit worse.
No, he's set the rules. So Donald Trump has decided that he would apply a 25% tariff to imports of cars from the UK, but in his bromance with Keir Starmer, he's decided that he will allow some cars, 100,000 only a year, to be taxed at 10% tariff only. But guess who gets to decide which car manufacturers get their allocation of that 100,000 at 10%?
Yeah.
The government. And we know how good they are at making decisions, don't they, Claire, around business?
I think this is a really horrible, sticky situation for Keir Starmer to be in. So just for context, I think the UK charge, is it 2.5% tariffs on car imports from the US, and our exports of cars into the US every year are worth about 9 billion a year. So there's a huge amount of cars going there, and obviously car manufacturers are very worried about that going up to 25%. It's going to make them pretty much not viable and massively reduce the amount of cars that are exported, exactly what Donald Trump's trying to achieve. But the issue that Keir Starmer's got is he has obviously attracted big international investment, or not Keir Starmer, but the UK has historically attracted big international investment from, foreign companies such as Nissan and people like that into the UK to build plants here and produce cars here. So who's he going to favour? Is he going to favour the traditional British brands like Jaguar Land Rover?
Yeah.
Or has he got to keep sweet the international brands like Nissan and Kia who are manufacturing cars in the UK?
Tough old decision.
Very, very interesting, because
personally, I just feel like it just can't. How can you not back British? I mean, it would just be mental, wouldn't it? Politically, it'd be suicide for him. But that's the difficult decision, isn't it?
There's a lot of talk at the moment, particularly from Nissan, saying that it's not viable for them to produce cars in the UK without they do get a lot of support from the government.
Yeah.
And we know in particular that the UK has got the highest energy costs in the world. And, if you're running a manufacturing plant and making cars, you're using an awful lot of energy. So the fact that it's not really viable, and then you slap on these 25% tariffs, I do think that we run the risk of the manufacturers leaving the UK if they don't share the subsidies equally.
And it's just another thing that takes jobs from them, because, like you said, some of the biggest plants I know, you've got like Toyota in Derby is absolutely massive, and again, not British. So, like, where does this land? I mean, we all. They always talk about sort of Jaguar Land Rover as the big one, don't they?
But is it really British? I think...
it's Indian.
Yeah.
It's owned by Tata,
exactly. So if you look at the ownership, is it British at all? And therefore, should it just be fairly distributed?
I guess the brand is seen as British, isn't it? So it's kind of... I think, again, will it be a business decision or will it be a political decision? That's what will be interesting to see, won't it?
Yeah, interesting times ahead.
Yeah, this week's fantastic news story. Anyway, this week we are going to unearth some lurking taxes in this week's Deep Dive. So, Claire, the hidden taxes that are lurking in your group structure, paint the picture for us about what we're talking about this week.
Yeah, so I've had a couple of situations over the last few months where people have acquired another business for various reasons. Some people are buying businesses, actively buying them and adding them into their portfolio. But other situations are maybe less planned. For example, we've got one customer and tragically their father died, and their father had a business which they've taken over. So now they've got multiple entities, and all of a sudden there are some additional tax implications that need to be considered, that particularly if you're running a slightly smaller business, maybe turning over low six figures or something like that, these additional taxes potentially that you're going to pay could make the difference as to whether that business is viable or not.
Okay, great. So how many have we got that you're going to go through?
We've got four different taxes.
Okay, so in a structured manner, let's start with number one.
So I'm actually going to start with business rates, because I think this is not like a HMRC tax, so we're just going to get this one out of the way right now.
Okay.
So business rates, a lot of small businesses in the UK are eligible for small business rate relief. So if you've got a business rate bill under a certain threshold, which I believe is 20,000, 21,000, then you get small business rates relief, which essentially means if it's under 15,000, you don't pay any business rates at all. And then there's like a tapered rate, so it is reduced up to the maximum threshold. So if you're a business at the moment that's currently claiming that, so like my office, for example, that gets business rate relief, fine. So if I decided I wanted to expand and get another office, then actually my eligibility across all of my properties gets removed.
Okay, so you just completely lose that because you've grown.
Yeah, and so It's not as hard and fast as that. So you do get a 12-month grace period on your current property that you're in. You get 12 months grace period. And there are some rules. So, for example, there is a rule that says, I think it's around £3,000. If the rateable value of each individual property is not more than £3,000, but that is, we're talking like a lockup or something like that that's going to have that sort of rateable value. So there are some really small exemptions, but in most instances, they're not going to apply. So what this means in a practical situation is if you're expanding and taking on multiple locations, then you've got to consider those implications of, what would the impact be?
And that's multiple locations under the same company. If you set up each location under a different limited company, does that change?
Yes and no, because you do have to be careful. But, ultimately, the government are wise to people just setting up separate limited companies to avoid taxes. So there are certain scenarios which you can set up separate limited companies and still claim business rates relief, but if they're connected companies and things like that, then sometimes the government will see them as one organisation, even if they are separate limited companies.
So if I had different shops I was opening and I wanted to put each one under a different limited company just for my own liability and various other things, would they see that as a
financial independence is a big thing? So there's various tests that the businesses go through, that the government goes through, and actually this kind of applies to all of the tax scenarios that we've got. So on a high level, even if you don't have a traditional group structure of like a holding company and then entities underneath it that are owned by the holding company, even if you just own limited companies and you own the shares yourself and there's no holding company structure, then the government or the rules will generally be around independence. So are the businesses financially dependent on each other? Do they share customers? Do they share resources? All of those types of things would then come into play.
Yeah. Okay, great. So that's business rates. Which one do you want to cover off next?
So we're now going to move on to the core taxes. And the three taxes we're going to cover is employers' payroll taxes, corporation tax and VAT. Okay. So we're going to start with payroll taxes and the employment allowance. So obviously there's been an awful lot of talk lately about the employment allowance because of what happened with the budget and employers' national insurance going up. So at the moment, employers can claim the $10,500 a year employment allowance. And that's essentially you don't pay that first amount off your employer's national insurance bill. Okay. Now, when you have multiple limited companies, regardless of whether they're in a group structure or not, you're only allowed to claim that employment allowance in one business.
Okay, so you don't get a new allowance for each limited company?
No.
Because they're connecting all those limited companies. What are they connecting the limited companies by? The director?
So this is actually where it gets tricky because the terminology and the language and the rules are slightly different depending on whether you're talking about corporation tax, VAT or employment allowance.
Okay.
As a very general rule, if the businesses are under the same control, okay, so if I own 100% of two businesses, both businesses are under the same control, they would say that they're connected companies.
Yeah.
Okay, but also if I own 50% and you own 50%, together we form control. So if we also have a controlling interest in another business, we might only own 60% together of another business, but we control both businesses. So you might think, it's fine because my wife owns 50% of the business. Yeah. Well, no, actually, two individuals can have
I smell like
together.
A proper good opportunity here for a floating limited company director service where I could go around just being put on people's companies under a contractual agreement just to make it change, just to change the control between the different companies so they can get the different allowances. It sounds like a great business opportunity, doesn't it? It sounds dodgy as hell, but also...
Yeah, because you'd have to have 50% of the business and then you'd become a controlling person across multiple businesses and the liability would be on you then. You'd connect all those completely random businesses together.
I never said it was a good business idea. I just said I can smell an opportunity here.
Yeah.
There's always a loophole somewhere. Great.
So just for clarity, control is basically 51% or more.
Yeah.
So if you own 50%, you don't have control, it's 51% or more. Okay, so that's generally
so if you had two businesses, same two directors, one on one company has 51-49 share, but it's the reverse, vice versa on the other company. Those two are not connected.
Yeah.
Okay. So it becomes a problem as you get multiple limited companies. If you had two, you could probably play the game.
Yes, yeah. And so if you're a husband and wife team, makes it a bit easier because transferring shares between husband and wife
have two companies, 49.
is relatively straightforward to do. It's just a paperwork exercise and there's not really tax implications normally. But obviously you do then have to consider what could happen if you got divorced, one of you died, etc., etc. So you can do things to mitigate this, but once you've got more than 2 companies, you're a bit screwed.
Okay, great. Let's talk about VAT then.
Okay, so VAT. So generally, the rules for VAT stay the same unless you decide to put your businesses into what's known as a VAT group. And that's when you can say to HMRC, all these businesses, we actually want them to have one VAT number, do one VAT return. So that's possible. You can have what's called a VAT group. If you don't have a VAT group, then the main consideration that's come up a couple of times in the last few months when I've been talking to businesses is about the flat rate scheme.
Yeah.
Now, the flat rate scheme is for small businesses generally. You can join the flat rate scheme if your turnover, I think the threshold is 160,000, but you have to leave the flat rate scheme only when your turnover goes, I should have researched this number, I think it's 230,000. Okay. So this actually, the wording on this is terrible in terms of the legislation, because it says basically that you're not eligible to use the flat rate scheme if you are eligible to join a VAT group. So if you've got connected companies, you're eligible to join a VAT group.
Okay.
And therefore you're not eligible to use the flat rate scheme. So this came up with that scenario with the gentleman whose father died and he inherited a business.
Yeah.
So he therefore is eligible to join a VAT group, and the business that he currently owned as just one individual company, therefore isn't eligible to be in the flat rate scheme anymore. And the flat rate scheme for VAT basically means that you charge 20% VAT to your customers, but you only pay over a certain amount of that to HMRC. And in his case, that was 10%. So essentially, he's getting a 10% boost on his profits. And because, unfortunately his father passed away, all of a sudden that's gone. And that 10% of the profits is a huge chunk of his profits.
So, what are the benefits of having a VAT group? It sounds like a better way of doing things. It sounds more efficient. Sounds like there's time savings, cost savings. What would you list as the main benefits of doing it versus the reasons not to group the companies together?
So the main benefits of doing it is, firstly, if there's one entity that gets frequent refunds, then all of a sudden, because normally you do a quarterly VAT return, if you do get frequent refunds, you can actually apply to HMRC and ask to do monthly VAT returns. Yeah. But that just simplifies that and make sure that you're not paying in one company and then waiting to get a refund in another. You can net those off and only pay the difference, so it can help in cash flow. The other scenario where a VAT group is helpful is if you have got a lot of intercompany recharges between your different businesses, because then you don't have to charge VAT on intercompany recharges. Otherwise, if you've got separate limited companies, VAT applies on everything that you recharge and cross-charge.
Perfect. Great. Okay, so the final one, which is the biggie, is corporation tax.
Yes, corporation tax.
And this is the one that always gets me in a bit of a knot. They call it the associated companies rule, don't they?
Yeah, and this is where I do think HMRC need to tighten up on the legislation and make it easier for businesses to understand. Because when you're talking about the employment allowance, they refer to connected companies. And VAT, they refer to VAT groups, and eligibility for connected parties is the terminology that they use. Sure. And then when we get to corporation tax, they're talking about associated companies.
Yeah.
So it's just
the terminology needs to be standardised so that people can better understand it. This one is really, really important to people that have, I guess, low levels of profit. But once you're a highly profitable business, it becomes a bit of a moot point, doesn't it? Because it's all about that moving up to sort of £250,000 worth of profit. So tell us the issues for those guys. Yeah,
so for corporation tax, the rules in the UK at the moment is that profits under 50,000 a year are taxed at 19%.
Yeah.
Profits over 250,000 are taxed at 25%. And in between that, there's a tapered rate.
Yeah. And we've done an entire podcast which you can dig out on the whole.
I
can't remember what it's called, but it's something about understanding corporation tax. And because I remember it when they started this, and it blew my mind. And I hated the fact that they just make it almost impossible for you to work out, if you're in the middle of that, what on earth your blended rate would be. But lo and behold, doesn't really matter where you are. You seem to be at the best part of 24%. You're never at the lower end.
Yeah, it always seems higher than you think it's going to be, doesn't it?
Exactly.
So what happens if you've got multiple limited companies that are associated? And generally for corporation tax, it's the ownership we're looking at. So the controlling ownership. If you or a group of people have more than 51% control of multiple businesses, they're classed as associated. And therefore, what that actually means is that when you're thinking about, do I hit the 50k threshold? Do I hit the 250k threshold? You have to add together the profits of all the businesses.
Okay.
So your business might be making 200k profit at the moment, which means you're going to be paying probably about 23% tax.
Yeah.
But you go and buy another business or you open another business, and then all of a sudden, both those businesses are put into that 25% tax bracket right away.
They just get lumped together and you add it all up. So there's just no way around this. It's all, again, same rules apply about controlling interest and various other things. So you can get away with this with two companies if you're husband and wife, or you're two partners, and you can do the control. But once you get to three or more, you're really struggling, aren't you?
Yeah.
To make this work.
And this is also something that is probably going to be relevant to quite a few people in our audience, actually, and is often overlooked as well, is there are actually different corporation tax schemes which define when you pay your corporation tax. So most small businesses in the UK will belong to just the small business rate scheme, which means that you do your tax return, then you've got 9 months afterwards, and then you pay your corporation tax bill in one lump sum. But there is something called a large scheme and a very large scheme. But the large scheme in particular applies if your profits are over 1.5 million.
Okay.
And if your profits are over 1.5 million, then you have to pay 4 quarterly instalments.
Yeah.
So all of a sudden, you're going to have this huge dent on your cash flow because you've gone
overnight.
Overnight, because you've gone from paying like 9 months after to all of a sudden paying quarterly instalments.
It's like that small cliff edge that people have when they hit VAT threshold when they're growing through a startup. What a nightmare! Yeah.
So for context, if your business is 1.5 million profit, then your tax bill is about 375,000. So all of a sudden, you've got to bring that tax bill forward like a year and a half.
Amazing.
That's a huge impact on your cash flow. So I think that what the purpose of this podcast is not to scare people.
It's to educate people.
Getting multiple entities, or especially when buying businesses. And this is where an accountant, when they're doing due diligence, it's really, really important that they understand, do you have other group companies and things like that? Because if you're doing, particularly if you're buying a smaller business that, might be doing 6-figure turnover and has got some low profits, their entitlement to business rate relief or their entitlement to the employment allowance could take a massive chunk out of your profit if you lose that. And therefore it could change the viability of whether it's worth you buying that business or not.
Yeah. Great. I think that's whether you've got a group structure at the moment, or more importantly, if you're a growing business and you're expecting to move into a group structure in the near future, I think that's essential that you're now aware of the things that will catch you out and will just frustrate you and annoy you. There's always, you always think that you can work your way through these things, and then you realise there's no loophole on anything and everything's just going to catch you out again. It's highly frustrating. So
I mean, look, if you lose your entitlement to all of those reliefs, like business rate relief, the employment allowance and the corporation tax, you could be looking like a 50k dent in your profit.
And it can be a big sort of cliff edge thing that you just need to, again, planning for it can just really help you.
Just got to run
get
the scenarios.
Yeah, exactly. Great. Fantastic, Claire. Well, let's move on to this week's Profit Cash Growth Extra. So this week, Claire, I have been playing around with ChatGPT, as I have done a lot since it came along. I love the tool. I just absolutely love it. And
but ChatGPT went down this week, didn't it? I don't know if anybody else noticed.
I didn't notice it. You said this.
I use it constantly. And it just kept erroring. So I was in the middle of actually writing some marketing letters that we were going to send out in the post, and got halfway through and it bloody broke, and it was doing my head in. I had to move to Gemini, and it was crap. I didn't like the tone of it.
Oh, use Claude. Claude's amazing. Claude's as good. In fact, it's better for written work. Claude is amazing.
I found Claude too slow, but I'm not sure if it's because ChatGPT was down that everybody was on it.
So the thing that I've used it for this week that I found amazing is transcribing handwritten documents into text. So basically typing up a document for me. Oh my goodness. And it's everything single thing I find with it. It's just a 10-minute here, 10-minute there. But basically we send our team out, and when they onboard a property, we have a key facts thing that they sit with the owner in the lounge, and they're handwriting it out because it's the quickest and easiest way to do within that form. And we would sit back in the office and we would type that back out so it's readable by people when they go out and do viewings and various other things. Well, now we just upload a picture of the handwritten document and upload the blank template, and we just say, can you type this up into this template? And it literally was 99.9% correct. I had to do literally one tweak on it, and the whole thing is a 10-minute job that actually took 60 seconds. I just love it. And
what I found really impressive was that you have like a checklist. It's basically just a table, isn't it?
Yeah.
There's like headers on the left-hand side, and then there's just a column where they write the answer.
Yep.
And in one instance, the team member had like crossed out the header to extend from the row above, and it was even able to identify that had happened.
Yeah, it was weirdly intuitive.
Yeah, it was really smart. But I love this. So meeting notes, like one-to-ones with my team, things like that. Obviously you don't want to sit there type into a laptop. You want your notebook.
Yeah. So you could just take a picture of your notebook and say, just type this up, and then you can save it down digitally. Brilliant. And because a lot of people can't read other people's handwriting, this really works nicely. So that's my little tip for this week. I'm going to bring you more and more and more of little reasons and things you can use ChatGPT for, because I keep coming across them, and I don't think it's all about thinking how you use this tool that's going to unlock things in your business. So thank you for joining us for another week's podcast. As always, if you feel like you might have outgrown your current accountant, you'd like to work with Claire and the team at Profit Cash Growth, nip over to the website, profitcashgrowth.com. On there, you can book a discovery call to chat with the team. Don't forget, on there, you can look at the podcast. You can order a free copy of Claire's book, Profit by Numbers, on there as well, if you want to start reading some of those bits and pieces. And join us again next week, where we'll cover another fantastic topic. And don't forget to share this episode with just one friend who also owns a business.